Hello again. Janet Yellen has been talking and talking, but have we actually learnt anything about Fed policy? Well, I've been to Global Reach Partners to find out. So there's lots of talk from Janet Yellen over the last few days. There seems to be a shift to talking about inflation. We all know about the employment mandate that the Fed has, but why is inflation now so important for the Fed?
I think it's another barometer they need to focus on in order to be able to increase interest rates. If you look at inflation, I think it's a bit more has been made out of it than needs to be. If you looked at the PCE, the core PCE, so strip out energy and food, which have been the volatile items, and we all know what the consequences of oil falling have been. But the core PCE for December is 1.2%, so it sounds a lot healthier than the headline figure itself. But they do need to try and increase inflation and need to find ways to actually warrant conditions to be raising interest rates. Now, the way I look at it is that they are forecasting inflation to go back towards its target of 2% in the medium term. So if that is the case, I don't see that they've got any problem maybe raising interest rates come June or maybe sort of quarter three, because there's obviously time lag between increasing interest rates and also how that is actually going to roll through and have the net effect into the economy as well. The other factor I think with regards to inflation, if you look at the price of oil, the monumental price of oil, that fell at the back end of last year. So by Q4 this year, that will already be factored into the index itself. So you can ultimately see inflation start picking up at the end of next year, and any increase in the commodity prices is only going to be a tailwind for inflation as well. So I think more has been made of it than actually needs to be.
How concerned do you think Yellen and the rest of the FOMC are concerned about productivity and wage growth? Because it's similar to here in a way that there are concerns about the quality of employment in the US and also concerns about the productivity, which historically seems quite low. Do you think these are going to play out, or do you think they're just looking at that headline unemployment number?
I think they are looking at a headline unemployment number. The headline unemployment number to me is positive. If you look at it compared to 2008, it's actually lower than it was in 2008. So one could argue we're moving back towards full employment. As far as the wage increase or the average earnings is going, again, more consumers will have probably more back in their pocket now because of the sliding commodities. But what I think everything's moving back towards is, yes, we know inflation is low, that's a given. We are seeing some positive numbers in terms of unemployment, but I think what we are looking at now is more the data dependency of the US economy as a whole, and that's where we will start to see a pickup in productivity. If we see productivity pick up, ultimately that could result in an increase in average earnings as well.
We've got this important US GDP number coming up. What are you expecting? There's concerns about wage growth again there.
Yes. Well, again, because we are expecting to see the figure revised downwards, which isn't really positive. It's expected to be revised down from about 2.6% down to 2.1%. Now, a lot of that is because of the strong dollar and ultimately US corporates that repatriating back into US dollars, and obviously that has taken a hit. And again, because we're ultimately seeing a downgrading growth in effect, and a downgrade obviously in corporate growth, that could ultimately hinder wage growth moving forward as well.
Yeah, it's easy to fall into cliches in these events in terms of US dollar, but do you think it's a case of buy the rumour, sell the news? Because we're moving towards that moment now when the rate hikes seems going to be imminent.
I think that's what the markets love doing. They've always done that. They're always going to continue to do that. I think everything's being signposted very well by the FOMC. I think they are ultimately trying to make it clear and as clear and transparent as they can. It appears like we are going to be removing that terminology patient at the next meeting. But I think what they've ultimately done is they've given themselves more time to potentially pull the trigger or have this lift off, which they're talking about in interest rates. So do we continue down that process? I think ultimately the markets have been doing that. The markets will continue to do that, and nothing's going to really change that acumen.
So put your money on the table. When do you think we're going to get this rate hike?
I think all things being equal, I think we are starting to see some clear language being used. I think we're probably going to be looking at the back end of Q2, maybe early Q3 before they start increasing interest rates. And I think the main thing is that they still believe inflation is going to go back to target in the medium term. Growth is still positive, employment is still positive, everything will follow through.
Well, thanks to Jamie for his analysis of events. Stay tuned to Duke's Copy TV for more interviews, but for the moment, goodbye from London.